19.7 are unchanged. And if we make that assumption, then we can work out the total earnings in millions of dollars for Crafts by simply taking the EPS and multiplying by the number of shares, and for Cadbury as well, taking the EPS, multiplying by the number of shares and multiplying by the exchange rate to put it into dollars. Once we've got the earnings, then the total value post-merger of these two bits of the group will be the PE ratio multiplied by the total earnings figure, and that will give me just over 42,000 million for Kraft and just over 13,000 million for Cadbury. If I add these two numbers together, that would be a reasonable estimate of the post-merger value of the group. And then to work out the total post-merger share price, all I need is the number of shares after the merger, and that will be the number of shares that we had in Crafts to start with, which is 1,500, and then, as we saw in Part A, we're offering 0.44 Kraft shares for every share in Cadbury. Total number of shares in issue will be 2,116, and then we can divide the total post-merger value by the total number of shares in issue, and that will give us a post-merger share price. At this share price, we can see that the merger would be unattractive to Kraft Foods, because Kraft Foods currently have a share price of $28. It isn't surprising that we haven't seen any benefit to Kraft of the merger, because so far we haven't factored in any synergy. And another way of working out a post-merger value is to use the concept of synergy and to find a way of incorporating that into the post-merger share price. And this is what we look at in Part C, where we're given some cash flows and we need to work out the present value of these cash flows and then feed that through into the post-merger value. Let's have a look at how we could do this. So if we look at the present value of the synergies, we're given the cash flows before tax in pounds. To take them as after-tax numbers, I'm going to multiply by 1 minus the tax rate. So here I'm going to be multiplying by 0.7, and that gives me the numbers in pounds. I then have to multiply by 1.65 to take those into dollars. And once I've got them in dollars, I've got to discount them. I'm discounting at 8%. We're going to use the annuity tables. The annuity tables will tell us to use a discount factor of 6.710, but that's only going to be appropriate if you've got the cash flow from time period 1 to 10. So to get the appropriate discount factors, we need to subtract the discount factor for year 1, or in this case, the discount factors for years 1 and 2, because those are the time periods for which we don't have those cash flows. The resulting present values total 7619. We already know from Part B that the post-merger value is going to be approximately 55,283, although we only calculated that by making an assumption about a price-to-earnings ratio. So we're then going to add on the synergy to get a revised value, and then if we divide by the same number of shares that we calculated in Part B, it will give us a revised and much more favourable post-merger share price. And we can now evaluate whether the merger is in the interests of both sets of shareholders, and that's what we're going to do in Part D. We know from Part B that Crafts had 1,500 shares. Okay, that's in millions, priced at $28, and so they had a total share value of 42,000 million. What we've now said is that after the merger, their 1,500 shares will be worth 29.73, and that gives a total valuation of 44595, which is 2591 million higher. So Kraft have gained. Cadbury, again, from part B, we know the number of shares, we know the share price, and we can multiply by the exchange rate to see what their shares are currently worth. And then afterwards they have 1400 shares to start with, but they now own 0.44 Kraft shares for every Cadbury share that they previously had, and the share, as we know, is worth 29.73. So multiplying that through, that gives a much higher value, and we can see that Cadbury will definitely gain. And therefore both sets of shareholders would be happy with the outcome, but perhaps Cadbury more so, because it looks like at the price being offered they will gain more from the combination of the two companies than will Kraft. And that's why we might think about recommending a change to the terms, because it would be unusual for the company that you're bidding for to walk away with most of the gains. And that's what we look at in the final bit of this example. In part E, we look at how the terms might need to be revised so that the bidding company gets at least 50% of the gains of the merger. This is typical of the style of the exam, to make you think about the numbers that you're calculating, but obviously real exam questions could be slightly different from this, but along the same sort of theme. Okay, so first of all, we know from part D what the gains are. If we add them together, and the total gains from the merger are 7626, half of that would be 3813. So that's what we're trying to give to Kraft Foods now. There are a number of ways that you could approach this problem. Here we're going to look at how we could take the 3813 desired gain and spread it over the 1500 million original Kraft shareholders before the merger. So that's going to mean that when we spread over the 1500 shares, we're looking for a $2.54 price rise, and given that the original share price is 28, $2.54 above that, that's our target. Okay, well, we know from part C that the total value of the group is 62,902, including the synergy. And if we want to get back to a share price of 30.54, then the number of shares that we're going to need will be that amount which, when divided into 62,902, gives 30.54 as the resulting share price. So the calculation here is 62,902 divided by the share price, and that's going to tell me that I need that number of shares post-merger. So if that's the number of shares that we need in total post-merger, well, we know that we currently have 1,500 million shares, and that means that an extra 560 will need to be issued. 560 Kraft shares for 1,400 Cadbury shares, so now we're recommending that the offer becomes 0.4 Kraft shares per Cadbury share, not the 0.44 that we had in part A. Section 3 briefly looks at some regulatory issues that affect takeovers. First of all, we have the City Code. This is UK specific, and so it won't be tested directly, but you might want to show awareness of it if you feel it's relevant in a question. Lecture Example 5 goes through a few of the key rules in the City Code. You don't have to remember these rules in detail, but you'll find it interesting to work through the example just to look at some of the principles that companies are meant to work towards. To prevent the uncertainty of whether a company does or does not intend to make a bid, if the bidding company has done anything to indicate that an offer is being considered, then in the UK the takeover panel will impose a time limit for the bidding company to clarify its intentions. This happened to Kraft Foods in 2009 when the takeover panel imposed a limit forcing Kraft Foods to state their intentions by November the 9th, and on November the 9th they announced that they were going to bid for Cadbury. The UK City Code also introduces safeguards to protect both the offeree company and the bidding company. So the bidding company must be able to confirm that it has the resources available for a cash bid, and the offeree company must get independent advice on whether they should defend against the bid and to make known to their shareholders if they disagree with that advice. To prevent one shareholder from gradually increasing their stake until they have ultimate control, Rule 9 forces shareholders that have more than a 30% stake to make a takeover bid for the other shares at no less than the highest price that they've paid for these shares over the last year. And finally, there are rules to make sure that the takeover bid proceeds in a timely manner to allow both companies to move forward in the event of the bid failing. It's also worth being aware that in the UK and in most countries there are regulatory authorities to make sure that firms don't dominate markets and exercise monopoly power to push up prices. If a takeover is likely to push your market share up above 25%, then it's worth mentioning in the exam that this could attract the attention of the regulatory authorities, who can block this sort of bid. After acquiring a company, it's going to be absolutely critical that you've got an integration plan that's been prepared in advance to make sure that you realise the value from the merger that you're looking for. There are a couple of theorists here that present a few ideas. This is not a theoretical exam in the sense that you need to remember the theorists and quote exactly these ideas, but you might choose to use some of these ideas if you think they're relevant to a question that you're answering. It is very unlikely that you are going to use all of these ideas in any answer. Typically, when you're buying another company, before you complete the acquisition, you need to have a plan to make sure that you can put key new management in place, and if they're coming from within your business, that you know how those managers are going to be replaced in turn. You've also got to have plans in place to hold on to your existing staff in the company that you're buying. And you need to have a clear idea as to what the reporting relationships are going to look like and any changes that you want to make to the organisation structure in the company that you're buying. After making an acquisition, it's common for the bidding company to seize control over capital expenditure, to do a position audit to identify the strengths and weaknesses of the company that you've bought, and then to set challenging targets for synergies, ensuring that you're adding value to the company that you've bought. But as you try to implement change, to make sure that you're consulting as well as telling. And finally, as part of the process of change, you'll want to make sure that cultural issues and information systems issues are addressed. Acquisitions don't always make sense. Sometimes companies find that they're too big already and need to split themselves up. Trying to find an appropriate way to exit from a business is called an exit strategy, and there are various types. Sell off to a rival, sell to your management team, split up the company into two separate legal entities, or simply close down a division, sell off its assets and repay the creditors. The type of exit strategy that's appropriate depends on what you're trying to achieve. If you need to raise cash, then a demerger would be an inappropriate suggestion, because a demerger simply splits you up into two or more separate legal entities. However, if your motive is to get out of a non-core area, possibly as part of a takeover defence, then a management buyout would look very attractive, because this is a common way of exiting from a business in a way that can be viewed positively by your existing staff. Finally, if you're looking to realise the synergy that other owners may be able to enjoy, then probably that's going to mean a sell-off. You'll cover this area more in paper E3, Enterprise Strategy. A recent example of an exit strategy was GUS, which demerged into Experian, a leading information systems and marketing services group, and then Argos and Homebase, which it kept together because it felt there were overlapping synergies there. GUS announced some expectations of the demerger: enhanced shareholder value, 2 different listed companies with clear market valuations, and freedom to manage their own resources, and the ability to align their management rewards more directly with their own business's performance. The terms of the demerger were that for every 1 GUS share that shareholders held, shareholders in exchange received 1 Experian share and 1 home retail share. GUS shares were cancelled. It's absolutely crucial in this exam that you can not only evaluate a potential acquisition using numbers, but you can also talk about the strategic reasons for an acquisition, how it might be financed, possible regulatory issues, and also the need to make sure that after the merger you've got a sound integration plan. It's also very important that you know the term exit strategies and that you can discuss the various forms of exit strategy. You need to pay close attention to this chapter in your final revision. That completes this chapter debrief. PCO is an exam standard question. You'll find it in the question and answer bank at the back of the course notes. You can either choose to have a go at the question and then follow the debrief, or to simply read the question through using the guidance that we're about to go through, and then follow the solution as it's presented to you. Which route you choose will depend on how prepared you feel at this stage of your studies. Okay, let's have a look at the question together. The introductory paragraphs are always important. Here we're told that a company called PCO operates in oil and related industries and is quoted on the London Stock Exchange. It has concentrated on high quality service at its service stations, not just price. So it's following a differentiation strategy. Having said that, 60% of its profits are still coming from petrol and even more from revenue. So it's clearly got some high profit margin items outside of petrol revenue. And we're told what these are. We're also told that the company has bought very well in the past and does not enter into supply agreements It's also facing intensifying competition and environmental legislation. So the MD is looking for an acquisition that will help the company increase its non-petroleum revenue, presumably to get away from those competitive and environmental pressures. So we're looking at acquiring OT plc, which is an oil distribution company quoted on the alternative investment market, and we're given a brief description of what it does. However, we're told that a bid would not be welcome. Okay, so that's the scenario. Let's look past the numbers now and have a quick look at the requirements. The bulk of the marks are in Part B. In Part B, we have to discuss and advise on 3 different areas. How much to offer to OT's shareholders, a bidding range, and you've looked at that idea earlier, how to finance the bid and the effects of the financing, and then whether the bid is going to give you the strategic benefits that you're looking for. So that's what we're going to concentrate on. Part A, for 6 marks, asks us to do some calculations, and as you'll see, these are preliminary calculations that will help the discussion in Part B. There are quite a few calculations to do. Let's start off by doing these basic calculations in Part A. So we're going to focus on the market value, PE ratio, cost of equity, and the share price using the dividend valuation model. And we have to do that for both companies, the bidder and the target. Okay, we're now going to start to work through the solution, so you've got a choice of pausing and attempting it yourself, or simply following the presentation through. Okay, so in Part A we have to do calculations for the 2 companies, PCO, which is making the bid, and OT, which is the company that PCO wants to buy. And the first thing that we're asked to calculate is the current market value. Now this is given in the question. 967 pence for PCO and 1020 pence for OT. So the only way to add value to this would be to multiply by the number of shares to show the total value of the 2 companies. So that's what we're going to do. The total value of a company is sometimes referred to in exam questions as market capitalisation. We're told in the question that PCO has 40 million shares in issue and OT has 24 million shares in issue. So multiplying through gives the total market value. We're also asked to work out the PE ratio. Well, we've already got the share price. In the question we're given earnings per share, which I've converted here from pence into pounds. And once we've got the earnings per share, then the share price divided by the earnings per share will give the PE ratio. And this gives a PE ratio of just over 9 for PCO and just over 11 for OT. So the company making the bid appears to have slightly lower growth prospects than the company that it's buying. We're not asked to do any commentary at this stage. In Part 2 we're asked to work out the cost of equity of the 2 companies using the capital asset pricing model, for which the formula is given. The risk-free rate is 4 and the market return is 8. And so if we slot in the beta factor that's given for PCO, which is 0.9, then that gives us 4 plus 4 times 0.9. 4 times 0.9 is 3.6. So 4 plus 3.6, 7.6%. And then doing the same sort of calculations for OT, but using its beta factor of 1.2. 4 times 1.2 gives 4.8. 4.8 plus 4 gives 8.8. And then finally in Part A we're asked to use the cost of equity that we've just calculated in the dividend valuation model, and again the formula for this is given on your formula sheets. Let's start off by applying this to PCO. So PCO we know has got a cost of equity of 7.6%. So we can put that in. In the question we're told that its forecast growth rate is 5%, 0.05, and we're also told that its latest dividend is 32 pence, 0.32. Now we're looking at the dividend in 1 year's time, so we'll take the 32 pence up by 5% growth. And working those numbers through suggests a share price of £12.92. Now let's do the same thing for OT, so just changing the variables. The cost of equity is 8.8%, the growth rate's 9%, the dividend is 21 pence. And as we attempt to use this, we can see that at the bottom of the formula we're going to end up with a negative number. So that's going to give a negative share price. That's one of the problems with this formula. It doesn't work for high growth companies. And so it's best just to put in not applicable. Now on to part B. Before we get into the detail of part B, it's useful just summarising where we are. We know the market value of the two companies based on their quoted share price. From that we've got the PE ratio, we've used the beta factors to get the cost of equity, and we've got an alternative valuation using the dividend valuation model. As you use information in an exam question, it's worth just checking it off on the exam paper. This will help to identify the bits of the financial information that have not yet been used and therefore may well be relevant to part B. Also, before moving on to part B, we should check that we've answered the whole question. We've done the calculations, we've done it for both companies, and yes, we have picked off all of the relevant bits of information. Now we can get into the discussion part of the question. We're not going to write up a whole answer here, we're just going to show the basic approach with all of the calculations that you would have drawn on. In the first bit of part B, we need to come up with a range of values and then to determine what the price to be offered will be. The numbers that we've got to work on from part A are actually fairly limited. We've done a lot of calculations, but the only valuation figure we've got for OT is the 244.8 million, or £10.20 per share that we started with. So we discussed this number, and we'd make the point that the company is listed on the AIM, so there is the risk that its shares aren't being regularly traded, and that this share price may not be a fair reflection of its value, and it may either overstate or understate OT's true worth. So where can we look for other valuations? Well, looking back to the data that we haven't used, we've got an earnings figure of 70 million, which you would sometimes multiply by a PE ratio, and we could attempt that here, but I would probably simply make the point that the PE ratio isn't really appropriate when you're buying companies in different sectors, which is what we're doing here. We're buying a distribution company, so I would mention that and choose not to use it. However, the NPV should be relevant if that's what we think the NPV is going to be. So taking the 720, if that's what the company is worth after the acquisition, then I'm going to subtract the 386.8 million that PCO is worth before the acquisition, and that will tell me that the acquisition of OT as a maximum will add 333.2 of value. So that's 720 less 386.8. And then if I take the 333.2 and divide by the number of OT shares, which are 24 million, then that's going to give me 13.88. That's the very maximum that I could ever consider paying for OT, and that's well above the share price. And that's pretty much as far as we can go with the numbers. And then all the examiner will be looking for is recognition that the 244.8 is really the minimum that you'd pay, because that's the current share price. The 333.2 is the maximum, and so you're going to pitch a bid somewhere in there, in that range. So perhaps the share price plus 10%. Although you might have to go higher here because it's a hostile bid. A 10% premium would suggest an initial bid of £11.22. And that's just taking the £10.20 and multiplying by 1.1. Okay, so that's what we'll suggest here, but other numbers would be acceptable too. Now let's move on to part 2. In B part 2, we're asked to consider both a cash and a share bid. Let's start with a cash bid. If we're going to pay a cash amount of approximately 269 million to buy the 24 million shares in OT, then we're going to have to borrow some money, because we can see from the question that PCO has just over 100 million of cash and marketable securities. It's unlikely to want to use all of that cash to fund the acquisition, so let's assume that it uses about 69 million, leaving it with a 200 million loan. Clearly other assumptions are possible here. But if it does borrow 200 million, then we can look at the impact on PCO's debt ratio. We know from the question that the debt ratio of PCO is 17%. PCO will also have to service OT's debt, and OT's debt ratio is 14%. The current value of PCO and OT we've calculated from part A, and these values represent 83% of total value and 86% of total value respectively, looking back to the debt ratios. So the actual amount of debt that PCO currently has is 17/83 of its equity value. And similarly for OT, it's 14/86 of its equity value. Note that you could pick up the value of PCO's debt directly from its balance sheet in this question. So after the acquisition, we're going to have all the debt that we had before, which totals 119 million, plus the extra 200 million that we're picking up. So if that's the debt post-acquisition, and we take that as a proportion of the company's value, debt plus equity, using the valuation of equity given in the question of 720 million. Then the key point for us to discuss is whether the company, PCO, would be happy for its debt ratio to increase from 17% to approximately 31%. And this is a very dramatic change, and so we could suggest that perhaps the company would be unlikely to go for a cash bid in this case. But let's have a look at the share option first, the option of purchasing OT's shares with PCO's shares. If we're going to offer £11.22, and remember there are other possible assumptions there, and our share price is £9.67, then that would mean that we're going to offer approximately 1.16 of our shares each time we buy a share in OT. And because there are 24 million OT shares, that's going to mean that we're going to issue about 28 million new shares in PCO to make the acquisition. And that looks affordable, because we currently have in issue 106 million shares, and so we're not going to be surrendering a great deal of control in the company. So we would probably prefer here to make a paper bid, or perhaps a combination of shares and cash, perhaps giving shareholders the option. Now let's move on to B part 3. Let's just plan an approach to this final bit of the question. The effect on existing operations. Well, we know that the company that we're buying also supplies our rivals, and there is the danger that our rivals will react adversely to this move and will stop using the distribution company that we're buying over time. So there's the danger that we damage the company that we're buying in the process of acquiring them. The company that we're buying does have a higher PE ratio, which signals higher growth prospects. However, the company's stated strategy is to try to move away from petroleum, and so we'd wonder whether perhaps a different acquisition might be more appropriate. Perhaps an acquisition of other service stations with bigger plots of land, giving us more scope to expand our non-petroleum activities. And finally, there's the risk that we don't understand the culture and the style and the strategy needed in the company that we're buying. It's a form of vertical integration, and this is typically a danger with this sort of strategic move. So that's a plan of the sort of things that you might have talked about. Now, to complete your debrief of this question, you should read the solution, looking at some of the other discussion points made and the style and structure of the answer. Remember that this is an exam standard question. You should work through the calculations carefully, but note that this question was as much about the discussion areas as it was about the numbers, and as you're reviewing the question, make sure that you're comfortable with the discussion points made, as well as ensuring that you can use the formulae and you can follow the calculations.